Welcome to my YouTube channel. In this video we are talking about finance. What is finance? Finance is a broad term that describes activities associated with banking, leverage or debt, credit, capital markets, money, and investments. Basically, finance represents money management and the process of acquiring needed funds. Finance also encompasses the oversight, creation, and study of money, banking, credit, investments, assets, and liabilities that make up financial systems. Many of the basic concepts in finance originate from microeconomic and macroeconomic theories. One of the most fundamental theories is the time value of money, which essentially states that a dollar today is worth more than a dollar in the future. Types of finance. Because individuals, businesses, and government entities all need funding to operate, the finance field includes three main subcategories. Number 1, personal finance. Financial planning involves analyzing the current financial position of individuals to formulate strategies for future needs within financial constraints. Personal finance is specific to an individual's situation and activity. Therefore, financial strategies depend largely on the person's earnings, living requirements, goals, and desires. Individuals must save for retirement, for example, which requires saving or investing enough money during their working lives to fund their long-term plans. This type of financial management decision falls under personal finance. Personal finance includes a range of activities, from purchasing financial products such as credit cards, insurance, mortgages, to various types of investments. Banking is also considered a component of personal finance because individuals use checking and savings accounts as well as online or mobile payment services such as PayPal and Venmo. Number 2, corporate finance. Corporate finance refers to the financial activities related to running a corporation, usually with a division or department set up to oversee those financial activities. One example of corporate finance: a large company may have to decide whether to raise additional funds through a bond issue or stock offering. Investment banks may advise the firm on such considerations and help it market the securities. Startups may receive capital from angel investors or venture capitalists in exchange for a percentage of ownership. If a company thrives and decides to go public, it will issue shares on a stock exchange through an initial public offering to raise cash. In other cases, a company might be trying to budget its capital and decide which projects to finance and which to put on hold in order to grow the company. All these types of decisions fall under corporate finance. Number 3, public finance. Public finance includes taxing, spending, budgeting, and debt issuance policies that affect how a government pays for the services it provides to the public. It is a part of fiscal policy. The federal and state governments help prevent market failure by overseeing the allocation of resources, the distribution of income, and economic stability. Regular funding is secured mostly through taxation. Borrowing from banks, insurance companies, and other nations also helps finance government spending. In addition to managing money in day-to-day operations, a government body also has social and fiscal responsibilities. A government is expected to ensure adequate social programs for its tax-paying citizens and to maintain a stable economy so that people can save and their money will be safe. What is the purpose of finance? The purpose of finance is to help people save, manage, and raise money. The answer is simple enough, but hardly ever spoken or acknowledged, which is a pity because purpose is the end towards which actions are directed. Purpose guides actions. Aristotle asked about the purpose of everything from medicine to generalship. In case you are curious, for Aristotle, the end of medicine is health, and the end of generalship is victory. Every action and decision is done for the sake of an end, a purpose. Finance needs to have its purpose enunciated and accepted. Students in finance should learn it in their business education. Perhaps the purpose should be taught even earlier at the elementary education level. Practitioners should be comfortable with the purpose of finance, knowing it implicitly and speaking it unabashedly. This acceptance and acknowledgement is a first step towards improving the culture of finance. The improvement comes about through the crucial bit of the statement of purpose that is ethically charged, to help people. This phrase instills the notion of the other in finance. The idea of the other is where altruism and ethics begins. Secular moral philosophy, from theories of justice to utilitarianism, concerns the other. The idea of helping the other also is widespread in religions from the Mosaic to the Eastern traditions. It is a basis of religious ethics. Christians are asked to love their neighbors, Muslims to show mercy to the less fortunate, and Buddhists to have compassion for sentient beings. What are the basics of finances? The basics of finances include the process of managing your money, and how you make use of the funds you are generating. Finances include a collection of areas like credit, investing, banking, assets and liabilities, and more, each being essential to your overall financial health. Number 1. How credit cards and interest rates work. I got my first credit card at 18, which was a smart call by my parents to encourage me to do so. This was key in establishing credit and teaching me responsibility with payments. Luckily, I was scared at first to do any real damage, but many others lack proper information. It simply comes down to not understanding how to properly use a credit card and how the interest rates work. It's critical to learn this information before getting a credit card, as it can keep money in your pocket and help you remain debt-free. Spend some time reading the fine print and understanding what you are looking at with any credit card applications. Number 2. How to balance a checkbook. If you are younger, you probably don't use checks or a checkbook very often. I used to write checks when I was a bit younger when managing my monthly budget, but not so much anymore. However, it's still an essential personal finance skill to know how to do. It can really help you learn how to manage your money, know how much is in your checking, and learn about overdraft fees. While I rarely write checks anymore, there are a few occasions where I do and need to ensure my checkbook is properly balanced. Number 3. The budgeting basics. To me, budgeting can be tedious and annoying. But it's such an essential skill to develop early and can save you future financial headaches. I focused on budgeting first when I started my financial changes, but now I do not pay attention as much once I have my system in place. Not focusing on budgeting is my personal preference and works for me. If you need to budget throughout your financial journey, there is nothing wrong with doing so. Yet, budgeting is a personal finance basic all should master at first. Spend some time on your bills, your living expenses, what you are spending money on, your savings. Number 4. Investing in stock market basics. Don't be intimidated or scared to invest your money in the stock market. It's an essential part of your finances in building wealth and securing your future retirement. Start with the very basics of investing, how it works. Then move on to managing your investment portfolio and what the maintenance looks like. You can learn on your own via investing books or websites, or you can reach out to someone you know who you trust and has been investing for years. You don't need to become the next famous investor like Warren Buffett, but you should be savvy enough to be investing and know why you need to stay invested. Number 5. Managing your debt. At some point, you may have debt. Whether that is from student loans, credit cards, mortgages, or something else. It's essential that you learn how to manage it from day one. The goal here is to understand how your debt works, what the interest rates are, and how to pay it off faster, as well as how to avoid future high-interest debt altogether. Understand why paying the minimum every month can drag out payments and cost you money, as well as various debt payoff techniques. How do firms finance investment? A large body of literature has found that in countries with weak institutions, firms are able to obtain less external financing, resulting in lower growth. Indeed, even simple cross-country comparisons of firm financing patterns can be quite revealing. In a paper co-authored with Torsten Beck and Vojislav Maximovich, this is exactly what we do. Using data from the World Bank's Enterprise Surveys dataset for 48 countries, we investigate what proportion of firm investment is financed externally, and, of this external finance, how much of it comes from different sources, such as bank and equity finance, leasing, supplier credit, development banks, and informal sources such as money lenders. Our results show that, even after we control for various firm characteristics and country and institutional variables, smaller firms finance a lower proportion of their investment externally, particularly because they make use of bank finance to a lesser extent. We would expect that small firms, facing informational asymmetries in financial markets, would rely more heavily on subsidized financing from government and financing from sources that rely on personal or commercial relations, such as trade credit or informal finance. We would also expect that such sources would be more significant in countries with poorly functioning financial systems or weak property rights protection. Our findings only partially confirm these prior expectations that small firms substitute bank finance with other sources of external finance, especially in countries with underdeveloped institutions and financial markets. Controlling for firm and country characteristics, we do find that small firms use significantly more informal finance than large firms. However, financing from such sources is very limited. Thus, the use of informal financing does little to relax financial constraints faced by small firms in developing economies. Moreover, we find that small firms do not use disproportionately more leasing or trade finance compared with larger firms. On the contrary, if anything, the opposite is true. In particular, financing from leasing does not fill the financing gap of small firms in countries with underdeveloped institutions because the use of leasing finance is positively associated with the development of financial institutions and equity markets. I hope you guys liked the video, and for more stuff like this, please subscribe to my channel and hit the bell icon for notifications. See you soon. Goodbye.